Hi. Let's learn about break-even analysis. A break-even analysis is all about comparing income from sales to the fixed costs of doing business. The goal is to figure out how much in sales will be needed to cover all fixed costs and start making a profit. This type of analysis also looks at the margin of safety based on revenues and costs. Break-even analysis helps determine the level of production or sales needed to cover costs. It involves calculating the break-even point by dividing total fixed costs by the price of each unit, minus variable costs. Companies with lower fixed costs will have a lower break-even point of sale. Investors may use break-even analysis to determine at what price they will break even on a trade or investment. This calculation can be useful when trading in options or fixed-income securities. The contribution margin is the difference between the selling price of a product and the total variable costs. It reflects the amount of revenue collected to cover the remaining fixed costs, which are excluded from the contribution margin calculation. There are two ways to calculate break-even analysis: dividing total fixed costs by the unit contribution margin, and dividing total fixed costs by the contribution margin ratio. These calculations help determine the sales volume or dollars needed to cover all costs and break even. Break-even analysis is used by a wide range of entities, from entrepreneurs and businesses to financial analysts and government agencies. Break-even analysis is important to businesses because it helps with pricing decisions, sales forecasting, cost management, and growth strategies. It determines the minimum sales volume required to cover total costs and break even. Break-even analysis assumes that costs remain constant over time and makes oversimplified assumptions about the relationships between costs, revenue, and production levels. It also ignores external factors that can impact a business's top line, such as competition, market demand, and changing consumer preferences. Stock and option traders use break-even analysis to figure out at which point their positions become profitable and to manage their risks through setting realistic profit targets and stop-loss levels. There are 5 components: fixed costs, variable costs, revenue, the contribution margin, and the break-even point. Fixed costs do not vary with changes in production or sales, while variable costs change with the level of production or sales. The contribution margin represents the amount of revenue needed to cover fixed costs and contribute to profit, making it an essential component in determining the break-even point. Businesses use the break-even point to make informed pricing decisions, sales forecasting, cost management, and growth strategies. It helps them determine the minimum price needed to cover costs and improve pricing strategies. Break-even analysis is essential for businesses and stock and option traders. It helps businesses make informed decisions about pricing, cost management, and operations. For traders, it facilitates profitability and risk management. In the financial world, break-even analysis is critical for decision-making and risk management. Here are 3 key takeaways. 1. Break-even analysis tells you how many units of a product must be sold to cover the fixed and variable costs of production. 2. The break-even point is considered a measure of the margin of safety. 3. Break-even analysis is used broadly, from stock and options trading to corporate budgeting for various projects. Hope this would help. Thanks for watching.